Thank you very much for the introduction. I'm flattered to be here. Thank you for including the paper in the program. So in the interest of time, I'll be focusing mainly on the first paper, Tokenomics, Dynamic Adoption and Valuation. This is joint work with Ye Li at Ohio State University and also Ning Wang at Columbia Business School. If we have some time towards the end of the talk, I'll talk about the corporate finance aspect more of using tokens. We're trying to shift to the economics aspect. So I would start from a different angle rather than talking about cryptocurrencies, so consensus protocols. I would start by asking what exactly do we need these protocols? Do we need this infrastructure for? If we think about how our economy has evolved, I would argue there is more and more kind of sharing economy, higher demand for peer-to-peer interaction, also the rise of on-demand labor. You can think about Uber, Facebook. I know they are not using blockchain or tokens per se, but they're thinking about that. In fact, Facebook had used Facebook credit before. Now they're thinking about Facebook or Facecoin. I don't know what that is named. If you are familiar with Tencent, they've used QQ Coin before. Within the gaming industry, tokens have always been used extensively, and actually people there have explored the economics quite a bit. So in that environment, what is really needed is a system or infrastructure for agents to interact, you can call it in a trusted way, to have transfers of value, business interactions with others through contracting, through some sort of agreement, and when disputes or contingencies are met, there needs to be ways to execute contracts, so on and so forth. So traditional firms or marketplaces, digital online platforms have dealt with that before. If we talk about, for example, Alibaba or eBay, the solution has been, I can create an escrow account, and the buyer can just deposit the money there until they receive a delivery of goods in a satisfactory fashion, then the money is transferred. That's still a centralized solution. The way, at least in these studies, the way we view blockchain innovation is really about providing decentralized consensus in order to enable these interactions in digital marketplaces, in digital ecosystems, rather than talking about countries or a physical community. So there are many benefits. Many of you have put forth, especially from computer science. The decentralization part helps us to avoid certain single points of failure. I just want to mention, in addition to technical failures, it also avoids some failures in terms of incentives. It's easier to bribe a single judge than a panel of judges, right? So you can, it's kind of an inclusive concept. Many people talk about disintermediation, the removal of intermediaries. I wouldn't emphasize that part too much. I think it's really about how to make the system more efficient, how to fill in missing markets, and how to encourage more competition. And that in turn will lead to reduced rent to intermediaries, which would give users more surplus. And finally, in the morning keynote, we also saw, even for blockchains that's not public, that's without cryptocurrencies, that could be an innovation to enable databases or information to interact while still preserving privacy, which is very important. So today, though, I'm going to focus on a case where we do have tokens or cryptocurrencies. I'm going to refer to cryptocurrencies and tokens generically as tokens here. And I'm going to focus on the ones that are used on platforms or in digital marketplaces as means of payment, which I believe applies to most cases in ICO and the cryptocurrencies we see. Of course, before I go to the example, there are cases where we are really talking about general payment currency, private money. I would say many people would view Bitcoin as one example of a private money trying to kind of challenge fiat money. That's not our focus. It's one end of the extreme. The other end is kind of platform-specific tokens. So what are some examples? I think these are probably familiar to you already. Filecoin, decentralized cloud storage. Definity, kind of decentralized cloud computation. Kin is kind of in some legal issue, but social network that's enabling the whole community to develop more business applications within that ecosystem. So what tokens are used for on these platforms it's a way for users to have P2P transactions. It's a way for the system to compensate certain contributors to the system, such as miners. You can even view crowdfunders in ICO, STO as decentralized contributors, or open source developers, right? It's kind of a one-time ad hoc interaction. One day I'm the driver, I'm a contributor. The other day I might be a consumer. So it's really enabling this type of interaction system-wide, even though people haven't met one another, or we don't know the identity of some players in the system. And of course, there are also exchanges with other cryptocurrencies. So that's what we are going to focus on. And if we think about this type of platform tokens, right, not so much about general payment private money, there are a few features that are very salient. I wouldn't say unifying features, but they are very salient. Number one is they are used on these platforms. I already mentioned many practitioners will argue, oh, this is a way for all the agents, all the nodes in the network to have some stake in the ecosystem, which we weren't able to do when the internet or HTTP protocol was first introduced, or when Facebook was first introduced, right? It's the entrepreneur team that's kind of having I wouldn't say monopoly, but a lot of control and market power. And secondly, these tokens are oftentimes not cash flow based. It's not just about digitization of known securities. They are really kind of platform tokens, which is related to how you run monetary policy, but rather than at a country level, now you're doing it within the ecosystem, at the firm level, at the platform level. Right? So that's one kind of salient feature. Another salient feature is typically the platforms feature network effect. The more users there are, it is easier for me to meet my transaction counterparty. So I would derive a higher utility being a user of the platform. Right? Social network is an example. Decentralized storage. Right? If I go onto the network, I better be able to find some buyer or seller of spare storage. Otherwise, it wouldn't be worth my time logging in and searching there. And finally, at least in this stage of development, most of the platforms are in early stage, I would say. So there's definitely endogenous adoption. Unlike a country's currency, when you're required to use it, you need to use euro in France. Here, we do have people who are endogenously deciding whether to be on the platform or not. And that decision of switching cost is not very high, right? So there's endogenous user adoption. Here, just related to the point of endogenous adoption, I'm just plotting the number of active addresses of Ethereum blockchain against the market cap over time. So you can see there's a very high correlation. I'm not saying it has to be perfectly correlated. It's just there is something there about endogenous user adoption. Right, that's good. It's not too hard to imagine when there are more people adopting that might affect the token price within the system. So what we want to do in the main model I'm going to introduce is we want to model this co-evolution of token pricing as well as platform adoption. And in our model, we're going to feature heterogeneous agents. Agents have different transaction needs. Some like the platform more. Some may not enjoy using the platform as much. And one set of results we're going to focus on is how do we develop a kind of fundamentals-based valuation framework of tokens. And here, by fundamentals, what we really mean is it's not only about the token itself, it's about the platform or the ecosystem or the community that the tokens are associated with. And that community typically relies on some technology. Decentralized cloud computation is not free. You need to develop algorithms to figure out ways to keep privacy and all that. So the value really comes from there in this regard. And then we can talk about cross-section and time series dynamics of token price. We also want to highlight the role of tokens. In particular, we're going to show two roles of tokens. Number one is it's going to help accelerate user adoption. That's something akin to what practitioners often mention when they say, oh, I'm going to bootstrap the community. in some ways related. Second one is less obvious. It's going to help reduce the user adoption volatility. I'll try to convey the intuition in a little bit. If we get time, of course, we can talk about more corporate finance issues on the platform. If you are the owner or designer of a platform, you are essentially making decisions of allocating resources. When do you want to grow the platform more? When do you want to distribute or dynamically allocate tokens to the decentralized contributors or to the entrepreneurial team? So that's very much a corporate decision making. And the typical conflicts or trade-offs could apply. We have insiders who are kind of owners or designers of the platform. We also have outsiders who are stakeholders of the ecosystem. How the wedge between their objectives is going to drive the decisions in the system could be very interesting. And in particular, and this is a question I get a lot, how do we design token? How do I decide how much to allocate initially for ICO? How much should I save to gradually distribute to all the community contributors, right? Some are called proposers. They can propose changes to the governance or the protocols over time. And how do I distribute that to my team of programmers and designers? So that's something I'll hopefully get to touch on. And in terms of relevance, why do we ask these questions? Firstly, for investors, if you are investing in the secondary market, we do need a valuation framework. I'm not saying you can take the formula and go there and make $1 billion, but at least we need to start somewhere, and many of you have contributed to this area. So we need to dispel the myth. Well, I shouldn't take a strong stand. We need to understand whether it's about bubbles or there's something fundamental. We shouldn't just say, oh, it's bubbles, it's hype, and then just, without studying it. And if you're investing in primary market, I think it's important to understand the roles of tokens. When entrepreneurs come to you, come to the VCs, they claim, oh, I'm using tokens, I'm using blockchain. Do they really understand why they are using it? If there's no network effect, or if there's some other issues that they are claiming, I think it's important to understand the implications. For the regulators, of course, this is related to how we can infer some patterns from price dynamics. And finally, for entrepreneurs, there is an aspect of designing the protocol or designing the token supply schedule that's not purely technical. There's some economic and monetary economics involved in how you want to grow the community. So that's something highly relevant. So that's why I want to look at that. There's a big line of literature many of you have contributed about, from the economics perspective, about solving the game, the protocol game, or designing the protocol, which is a mechanism design problem that needs input from both computer scientists and economists. That's not these papers are about. Ours are more related to taking these functionalities of protocols as given. What are the economic implications? And in that regard, it's related to platform economy, corporate finance issues. But in that regard, does it have to be blockchain based? Full revelation, it doesn't have to be. The economic mechanism doesn't have to be. But of course, blockchain applications very well motivate some of these observations and the way we model things or we interpret things. And in some aspects, it's going to make implementation or achieving these mechanisms easier. So without further ado, let me go to the kind of first paper's model. Here we have a generic goods as numeraire. You can just view that as we're measuring values either in terms of consumption goods or in terms of some fiat money, like say dollar. And we have a reduced form specification of the benefits of holding tokens and carrying out business transactions on a platform. And the specification is given by this equation 1. XIT is the amount of value a user holds on the platform. User I at time t. So it's just, I haven't introduced tokens yet. It's just the value they have on the platform for their activities, business transactions. NT is the measure of the total number of agents, the user base, community size in that setting. We introduce NT here to capture the network effect. The more people there are, it is easier for me to get a higher transaction utility flow from being on the platform. AT here is what we call productivity of the platform. For now, you can view that as exogenous. We assume it follows a geometric Brownian motion. Basically, we want some innovations in there, like shocks and uncertainty in there. What is AT? Well, you can view that as technical improvements for encryption. You can view that people's creativity in how to utilize the platform. When the Ethereum was first introduced, people may not necessarily have in mind, oh, I'm going to issue my own tokens on Ethereum platform. But later, as the community evolves, people come up with new ideas. It could also be regulatory shocks, such as a ban on trading cryptocurrency that could have an effect on kind of the platform productivity, because it's harder for people to get to use some fiat money to exchange for the token to use on the platform. UI here is each individual's preference or transaction needs. Some people, if I'm a drug dealer, I really need to use Bitcoin to complete the transaction, I would have a higher UI. Otherwise, if I'm totally against crypto, I might have a really low UI. Right? That's just a way to capture the heterogeneity we have among all the users on the platform. And so UI can follow a general distribution bounded and also given by GU. And finally, we assume there's a access cost to the platform. It's a pure modeling device to have an endogenous cutoff for the number of users who are using the platform. Another way to model that is to allow some people to really hate the platform so they wouldn't participate. Unless the utility value is high enough. So it's a modeling device. It's not going to change the results much. And coming back to this reduced form, it's again that's not something that's familiar to many computer scientists. Here, that's just a Cobb-Douglas production function. We're just going to specify that it's going to give us some tractability. But in the revision that we're working on, we are trying to come up with micro foundations for why the utility looks like this. One example would be staking. For example, if I use Filecoin, I want to provide storage space. In addition to proof of storage space, I have to stake tokens there as well in order to have a higher chance of getting to provide that service. So after providing service, I get back my token, and then I derive the profit from providing that service, right? That will be my utility flow. So that's kind of the platform and user side. Now comes the token. So suppose the platform requires the use of a native token. So the value I hold on the platform has to be in the form of I hold K tokens, and each one has price, token price, PT, right? That's just an accounting identity. But token price is going to be endogenous in the system. So we conjecture the price follows a general diffusion process, and we are going to solve for the time-varying drift and diffusion term. Okay, so basically, both adoption and prices are endogenous. So for users, what they maximize is just think about risk-neutral measures. Think about users as risk-neutral for the moment. When we bring it to data, we're going to calibrate under some risk aversion. So users are just maximizing this objective given in equation 4, basically the discounted utility flow from being on the platform throughout my entire period in the economy. And if we look at that surplus flow, it's basically the following optimization problem. Well, firstly, as a user, I have to decide whether I'm going to be on the platform. Suppose I normalize the outside utility or outside payoff to be 0. So I can choose to be not on the platform, therefore I get 0. But if I choose to be on the platform, I have to decide how much value to use, how much token to hold to carry out the transactions and business activities. That's related to choosing KIT. So if I do that, I get this surplus flow given in the reduced form I mentioned earlier. Of course, I'm holding all these tokens for that instant. I get an exposure to price changes. Of course, I pay the participation cost, and then we can assume, the opportunity cost of putting that value has a risk-neutral return R, right? Just to be to rule out arbitrage and be consistent in this framework. Now, solving this problem, if I decide to be on the platform, this is the number of tokens I should hold. All the kind of expressions are intuitive. I only want to point out the last one, right? The number of tokens I hold is increasing in the expected token price change, which is endogenous. So what this is pointing out is, it's not only about usage, it's not only about investment, it's actually a alignment of investment and usage that's playing a key role in this environment. I hold tokens to carry out transactions to get the usage value, but at the same time, I'm exposed to price fluctuations. To me, that's an investment aspect as well. So but mu PT is endogenous, so we are going to solve for that. But given this is how many tokens I want to hold as an individual user I can aggregate that up to figure out across the platform what's the overall adoption, aggregate adoption level. Well, the first expression I'm showing you there is just marginally the person who's adopting must break even, right? Trading off the participation cost versus the benefit they get. And then I can find a cutoff threshold across the user type. That would be my endogenous participation. Some people who like the platform enough, especially when the platform is productive enough, are going to participate. The rest are going to stay off-chain. So if we denote that endogenous aggregate user transaction demand as UT, and if we say the total token supply, for the moment, just think about it as fixed. We can introduce a constant inflation similar to what Bitcoin is doing, but just suppose the money supply is fixed for the moment. Then we can clear the market for tokens to figure out token price. And it's going to look like something like this in equation 8. Token price is increasing in the community size. That's the network effect. It's increasing in the aggregate transaction need, which is not surprising. Increasing in productivity of the platform. You know, the total token supply, number of tokens being supplied is in the denominator, is just money neutrality, right? I can supply more token, each one has less price. And finally, it's increasing in this mu TP. That again reflects this investment motive. So the idea is, suppose I'm at the beginning of HTTP protocol. I'm at the beginning of Facebook's birth. And as a community early adopter, if I expect the platform to take off in the future, now there's a way for me to get a share of that benefit. I'll just come use the platform more. I hold more tokens, and gradually I'm going to benefit from that token appreciation. Why does token price appreciate in that environment? Well, if the platform is going to do better, and if we have a rule-based supply schedule, that means the demand is going to push up price, because when the technology improves, more people are going to demand the platform, and that pushes up token price. Right? That's kind of the...
Is equilibrium unique?
A very good question. So I'll answer that question in a slide. If you look at this pricing formula, can you use it directly in practice? No. Why? Because mu TP is endogenous. So what this really is a second-order nonlinear ODE. To the extent that second-order nonlinear ODE has a unique solution, then and with the boundary specification, then we have a unique solution. We need some additional technical assumptions to get uniqueness. And of course, there's always a trivial equilibrium where price is zero, adoption is zero. That's always an equilibrium, right? So that's the ODE that I was talking about. So what boundary condition do we put down? Well, firstly, when the productivity of the platform drops to zero, token price drops to zero. That's kind of intuitive. The second one is not that obvious. The second one is really saying, after we reach full adoption, the entire unit measure of agents all adopt the platform, the token price just evolves in lockstep with the technology itself. So it's basically a golden growth model in economics term. What that rules out is, once we reach once we reach full adoption, there's no excess volatility to token price, right? That's why we call it fundamental. Another reason is this is a way to help us to understand what the role of endogenous adoption is, right? Because after reaching full adoption, we have a benchmark that's just based on growth rate of the technology itself. And before reaching full adoption, the endogenous adoption is going to play a role in affecting asset prices. So with these two boundary conditions, we can solve for the equilibrium. And I'm going to illustrate some of the implications of the roles of tokens using numerical solution by solving this differential equation. But before I do that, I just want to quickly recap the key mechanism that I've introduced so far. So basically, whenever there are technology shocks, if we look at one single period, what's happening is, okay, if productivity goes up, technology improves for that platform, my token utility goes up, so I participate more. And due to network effect, that leads to others to participate more. So that's a static contemporaneous network effect. But if there's kind of shocks going forward to the technology, I expect the technology to drift up, for example. That's going to lead to a higher future demand, which is going to lead to a higher expected token price in the future, which would attract me today to participate more. And there's an intertemporal loop, feedback loop as well. So that interacts with the contemporaneous loop to accelerate adoption. You may ask, okay, why do you assume the platform is going to take off? What if the drift of the platform technology is negative? Well, in that case, what's going to happen is tokens are just going to kind of precipitate the demise of the platform, right? Because people anticipate the price is going to drop, they participate less, and then due to network effect, other people also participate less. So that's kind of a key mechanism on the user side, right? Later, I'll introduce the kind of decentralized contributor as well as entrepreneurs. Okay, so let's look at some implications of the model of the main mechanism. To do that, we have to numerically solve it. But before I introduce the numerical part, I do want to introduce two benchmarks. Because after all, we're trying to answer a kind of economic question. We want to figure out welfare implications. What's the first best? Oh, what's the case without tokens? Can I run the platform without tokens? What's going to happen? So first benchmark is I can do the entire calculation without introducing tokens. I just hold XIT amount in terms of fiat money, for example, or numeraire on the platform, right? Suppose the platform just doesn't require me to use a native token. What's going to happen? Everything is pretty much similar, except that mu-TP term drops out, right? Because the fiat money or numeraire value is not determined by the platform itself. So I don't have that alignment of investment with usage motives, right? That's the key difference. What about the second benchmark? The second benchmark is what is socially efficient in terms of adoption? So that's kind of the real side, right? When we talk about token price, that's the financial market side. The real side is people are deriving utility from the platform. So what's socially optimal? Well, we can solve that problem in this particular specification. What is optimal is when the technology is above certain threshold, all adoption is optimal. When it's below a certain threshold, no adoption is optimal. It's a bang-bang solution. What's the intuition there? Well, we're talking about network externality. Individuals don't internalize their benefit on others when they participate. As a social planner, I would love to internalize that. That's why when the technology is good enough, I'm going to encourage everyone to participate, to fully enjoy this network benefit. So I'm going to compare the token-based platform to these two benchmarks in a little bit to highlight the roles of tokens. So to do that, I have to numerically solve this problem. And I'm just going to transform everything into the physical measure, right? We were talking about risk-neutral measure. As long as there's no arbitrage, there exists a transformation for us to go to the physical measure through Grassanov transform. I'm not going to touch on that too much, but basically I can introduce a stochastic discount factor, how much people are discounting future cash flows, just a simple one-factor linear model that's often used in some economic models. And after doing this transformation, I also take 16 major cryptocurrencies data. on infocharts.com for 8 years. And I'm going to match patterns in terms of their growth rate, the joint dynamics of price and adoption, NTS adoption. How do I proxy for that? Well, as a first run, we can use active user address. We can do it finer. I'm sure you have many algorithms to figure out how many independent wallets there are.
Yeah. Are we sure we can do the percent of change of measure? We're not sure the market is complete or perfect.
Right. So actually, we don't need the market to be complete. All we need to do is no arbitrage. There exists a kind of transformation, but it's not unique. And also, we need to assume there's complete market for idiosyncratic shocks over there. That's kind of what's going on in the background. But if you bear with me with that kind of assumption, we just want to match it to data and see what's happening. So we can pick some reasonable parameters, and then here's what we have. This is a curve of user adoption as technology improves over time on average, right? So it's an S-curve of adoption, not too surprising. But what's special here is there's also a price channel. Typically, when we talk about S-curve of adoption, we're not thinking about there's also a price channel, right? But cryptocurrencies here, we're assuming they're traded. So what we did is we matched data to the first half of the curve. You can do it for the first 1/3. And we want to see what the model would predict after calibrating the parameters, what the model would predict going forward. So that's kind of, the red dots are actual observations. And this is the adoption curve. Now, recall I've introduced 2 benchmarks. What's it going to look like in the benchmark case? Well, the green line, the vertical line here is first best. Basically, above that level, full adoption is actually socially efficient. And the red line there is a platform without native tokens. So you can see with tokens, the adoption is accelerated. So there's some improvement in terms of social welfare. Now, I plotted this for a positive drift of the platform technology. So that's a promising platform. There could be lousy platform that's going down, but that's also socially welfare improving with tokens because tokens accelerate the close down of the platform, which is also efficient. The second role of tokens, at least under this framework, is it's going to stabilize the user base. And here's the intuition. Rather than having you stare at the figures, I'll just explain the intuition in words. Suppose there's a negative shock on the platform productivity. Let's say a regulatory ban in some markets. What's going to happen? Well, because AT goes down, users have less utility flow being on the platform. So less people will adopt. But if they know the platform is still drifting up, it's still a promising platform, that means the room for price appreciation is bigger. Because now there's less people adopting it. That means in the future, there's more room for people to come in and adopt. And that's going to push up price. And because of that, price mitigates this negative shock in terms of technology when we translate that shock into user adoption. It basically acts as a buffer. And when there's a positive technology shock, the effect is similar. So, but this doesn't come free. Tokens stabilize user base, but the endogenous user adoption is going to amplify token price volatility. And that's something I'm going to show you on the next few slides. So just now, I was talking about user adoption dynamics. Now let's switch to the token price dynamics. So if we think about why crypto and tokens are so volatile, at least in this period, there are many reasons. It could be behavioral, bubble and all that. But fundamentally, could it be very volatile? Well, yes, if the technology, AT, is fluctuating a lot, the fundamental is volatile, then token price will reflect that. So that part is not too surprising. But with endogenous adoption, the volatility could be even bigger. The argument is similar to what I described about the stabilizing effect of tokens on adoption. Here is the not mirror image, the reverse image. So what I've plotted here is the blue line is basically some normalized volatility of token price over technology. So as technology improves, we could have an episode where there's very high volatility because we're going through an initial phase of endogenous adoption. And that volatility is further amplified if we allow a feedback channel, which is if the community is bigger, AT improves faster because more people are spending time thinking about how to come up with a useful app and all that, right? If we allow that, this feedback could be even bigger. That's the green line here. And similar effect would be there about user adoption acceleration with tokens. If we allow further feedback bootstrapping mechanism, that's just going to amplify all the effects I have described so far. Okay, so that's one asset pricing implication about volatility. What about the cross-section of token prices? So on the left-hand side, I'm plotting token price across the adoption life cycle. When the number of users go from 0 to 1, full adoption, what's the price is going to look like? What I want you to take away from here is, in the initial and final stage of adoption, it wouldn't be too surprising to see big price changes. But if you are in the middle stage of adoption and you see huge price dispersion, there could be some mispricing going on. Right? And where do I get this figure? It's basically the image of S-curve adoption kind of inverted. Right? So that there's some implication about cross-sectional token prices. We could also observe a price dynamic that looks like a bubble. There's an initial run-up in token price and then subsequent decline. Why is that? Well, due to anticipating token price appreciation, right? There's an initial, people expect that, and then in equilibrium, there is a run-up. That's not surprising. But as more and more people adopt, what's going to happen? This asset becomes more systemic. It's more correlated with our aggregate consumption when it becomes the major form of asset. So because it's no longer diversified away from other assets I'm trading, I have to discount that more. My discount rate would go up. Cash flow holding constant. So that leads to the decline part. Even though there's no behavioral bubble, it's just an all rational path of token price dynamics. I'm not saying this explains what we see in reality. This is, yeah.
This is not a time series, this is the next Y.
Yes.
Price against A. This is not the time series of price.
Exactly. So on average, it's kind of look like that because technology is drifting up. Yeah. You're absolutely right. Yeah. And there are many other factors contributing to this type of pattern. I just want to highlight this is possible. And we're now the first to talk about this. Pietro Veronesi and Lubos Pastor in their American Economic Review paper also talk about how when a technology matures, it's more correlated with the stochastic discount factor. So in the remaining time, I'm going to kind of enrich this framework a bit more to talk about how we compensate miners, decentralized contributors, how we dynamically allocate tokens. So for that, I'm going to endogenize the platform's productivity. Right? AT now is endogenous. How do I do that? Well, I assume AT is related to how much labor or effort is being put into developing the platform. Right? More programmers working on it is going to improve faster. So LT is kind of a labor, the number of people or number of decentralized contributors we have in this ecosystem. And effort itself is not enough. Effort has to be multiplied by a productivity. And what is exogenous and uncertain in this framework is productivity is uncertain, as stochastic. So the productivity, DHT increments, follows a geometric Brownian motion, right? That's kind of, we have to have something that's exogenous. We can't have everything endogenous. Then to compensate contributors, decentralized contributors, if they put in a labor of LT, I'm just going to assume there's a convex compensation cost that's typically assumed in corporate finance literature. What is behind this expression is I'm assuming the market is reasonably competitive. There is some convex cost, but we're not macro-funding it. But here, theta can be viewed as the tightness of a labor market, meaning how easy it is for me to find the suitable programmers or miners to contribute to the platform, right? A blockchain infrastructure could facilitate a easier search and match because people can just come online, they can be a contributor to the digital marketplace. Whereas in physical corporations, it's harder. I have to go out, have a recruiter, search for people and all that. And here, LT doesn't have to be labor. It could be financial contribution. I'm just generically referring to that as decentralized contributor. Okay. So that's kind of how the platform could grow. Now, what's the objective of a designer who's designing a protocol or allocating tokens? Well, they are deciding LT at any given instant in time, how much decentralized contribution I want to solicit, and also DT, which is my distribution of tokens over time. It should be small t there. There's a typo. And then if I distribute token to myself, of course I can trade it in the secondary market as a payoff to the entrepreneur. I'm also allowing a burning of tokens. Basically, I send it to a invalid address, so it's out of circulation. And of course, to burn token, I have to use real resource to buy it back, right? To burn it. I go to an exchange, I pay fiat money, get the token, and then send it to an invalid address. You may wonder why I ever want to do that as an entrepreneur, which hopefully I can convince you. But anyway, the token supply dynamics is basically how much tokens are being distributed to miners, to decentralized contributors, and plus the ones that's being distributed or burned out of circulation to entrepreneurs. In the case of Bitcoin, of course, the kind of distribution to decentralized contributors is kind of fixed. Every 10 minutes, now I'm distributing 12.5 new Bitcoins. But that's an ad hoc design, right? Here was saying, well, if we are able to fully endogenize that, what's going to happen? I'm going to skip the dynamic programming part, but the intuition for burning token really comes from, as an entrepreneur, I care about getting the token dividend now, getting some distribution to myself. But I also care about the franchise value of the platform. If the franchise value is great, I get more token dividend in future. So my trade-off is really, do I want to inflate a little bit to distribute some tokens to myself, or I want to deflate the ecosystem a little bit so that I have a higher franchise value? I basically maximize my continuation value. The last term comes from Ito's lemma. Second term is just a precautionary saving motive. Sometimes the labor market is uncertain, or productivity of the decentralized contributors are uncertain, so I want to have some precautionary motive there. And we can solve for optimal labor amount. This is going to be a system of second-order ODEs, and numerically we can solve it. How many more minutes do I have? Okay, I'll just go over maybe part of the panel. This is plotting how the platform would endogenously develop against the state variable we have. State variable, for the numerical solution, we're just using the number of tokens in circulation divided by the endogenous productivity. So it's kind of per quality service on the platform, how inflated the system is. So if you look at, let's say, panel B here, which is the continuation value, sensitivity of my continuation value as an entrepreneur with respect to a productivity change, plotted against this state variable. It's non-monotone for the following reason. Well, if I'm very close to the left boundary, what's going to happen is, okay, the system is deflated enough that's close to a token distribution boundary. So I love to see the technology of productivity improves a little bit, and then we can distribute dividends to the entrepreneur team. If I'm closer to the right-hand side, to a burning boundary, burning could be costly, so I don't want to do that because I have to raise real resource to buy token back and burn it. I would enjoy an improvement in productivity that pushes me away from the burning boundary. Right? So there are these things we can look at. Token return volatility, this is more about price dynamics. Just now I mentioned there are some factors contributing to volatility. Assuming exogenous growth of the platform, now we've introduced dynamic token supply, which is the supply side. So by adjusting or optimizing the supply side, what's going to happen is volatility can go down because when do I want to issue tokens? Well, when tokens are deflated, right? The system is deflated. That means token price is high. But when I issue token, that brings down token price. So it's always counter-cyclical. In that sense, I moderate the volatility or fluctuations in token price. And I'm going to skip the rest and just touch on one more thing, which is implications for stable token. Traditionally, how we have been approaching creating a stable coin or stable token. Well, one way is to use collaterals. We can change the financial product, make the least information sensitive part attached to the token price. Right? That's what Tether, Circle, that's what they are doing. Another way is a central bank algorithm, which I can issue kind of just like an open market operation. I can issue bonds to take back equity, to boost equity value, something like that. So that's another approach. But even in that approach, I'm not using any real resource. What the entrepreneur is optimizing in this framework is they're using real resource to burn token out of circulation. So that's an additional way of creating stability as almost like a byproduct. I'm supplying real resource to boost to support token value when the value goes down too much, and vice versa. So that's something we thought is kind of interesting. It's not in the entrepreneur's objective. It's not their optimization objective, but just as a byproduct, token volatility also goes down when they optimally design token supply. So I'm going to stop here. I just want to encourage everyone to think a bit more about the traditional corporate finance and asset pricing implications. Here is pretty much a pricing of assets with a dividend flow that depends on network size. There's network externality in general. I'll stop here. I think I might be able to take questions. Yeah.
Thank you for a good presentation. My name is Peder. I just wonder, in this framework, what is the assumption for switching cost? Because you can have a hard fork and then you can sort of copy the entire network, and how does that fit into the analysis?
Yeah. So one ingredient that's missing from the framework so far is we've been looking at one single platform. And in the paper, we do look at competition a little bit in reduced form. I think your question is related to kind of forking is one example, but if other people introduce a similar platform, that's going to affect people's adoption decision. So that's something not in the current paper, but something that we can explore. One example is if there's a competing platform being introduced, we just need to modify the boundary conditions to, for example, some reflecting barrier. Because as soon as the token price rises to a certain level, more entry would take place. And if the market is very competitive, then the price would bounce back. People leave the platform, right? So there are ways to model that to some extent, but I think a full specification of that is also something worth exploring. There is a kind of a participation cost in the model in reduced form. For that, what we have in mind is just some attention cost. Again, it's just a modeling device. We don't have to introduce that to have endogenous cutoff, but it's just an easy, kind of for tractability reasons, we introduce that friction.
Hi, I'm Olivier. Thank you for this presentation. I think the next step will be linking your model to equity token model in order to have a great comparison. My question is more about all the ICOs we've seen past 2 or 3 years have started with zero user, zero utility, and I've gone mainnet 1 year or maybe 2 years after. And in that case, your model almost implied that the token was zero at some point. So how did we came up with such a market?
Right. That's a great question, and that's a question I would defer to many of my fellow researchers who are working on ICO. Right, Hannah, Andrea, many of you have contributed to that. Andreas, so what is not quite specified in the current framework is the ICO stage. Right? It's kind of at time zero, things just happen. There is a pre-stage that's quite important, which we haven't captured in this framework, but there are definitely many studies. I think in the next few talks, we'll see some of the mechanisms being explored. Justin also has worked on that. Yeah.
Thank you very much for your presentation. My name is Arash. Could you please distinguish between a speculation behavior and the adoptions? Because it is very surprising to see that the adoption rate of Ethereum and price is highly correlated based on your definition, while we know that the speculation drives price a lot in this market too.
Yeah, great question. So one thing that we don't capture, at least with the boundary conditions we have, we don't capture is behavioral bubbles, right? There could be rational speculator in this framework. Who are they? They are the ones with very low UI. I just don't like the platform. And if I'm still holding it, it must be my expectation about token price change, right? That's definition of speculator in that regard. So that in that sense, it contains speculator. But if we're talking about behavioral bubbles, we have to specify the boundary conditions differently. For example, without requiring this transversality condition, we can have bubbly boundary condition, and that leads to price behavior that would fit a environment with bubbles, with kind of speculation that are not quite rational. And for that, we just have to pick the boundary condition, and we don't a priori we don't have a strong stand on what bubble boundary condition we pick. So we pick the fundamental kind of without excess volatility. Yeah. But if you have a good justification for certain boundary conditions, you can use that and then solve numerically and see how it's going to impact the price dynamics. So Justin has a question or no?
This is not a general question. It's a question about slide number 4 or something, where you're writing, I think something you call the flow of utility or something, XIT.
Yes.
Can we have a second look at this black magic formula?
That's right.
I'd like you to break it down for computer scientists. So, for example, there is an alpha in the formula. And a 1 minus alpha, actually, at the beginning. So how should I understand this? Should I think of alpha as nearly, small or something?
Yeah, alpha here is in the range between 0 and 1. Okay. The reason we have that is you notice the power do add up to 1.
Right.
It's just when we take a derivative to solve for first order condition, it's more tractable. We get a nice interior solution. But economically, conceptually, what that relates to is we can use that staking example, where if I want to provide storage space, right, I have to stake. The higher I stake, the higher chance I'm being matched with a demander of storage space. So that would be my XIT, right? And how am I likely to be matched with someone who needs storage space? Well, if we have a larger community, there's more likely to be someone who needs storage space. So in summary, in that regard, and AT is just matching technology. The platform is providing some search and matching technology. And in that regard, this can be viewed as a search and matching model. I can stake more, but my probability of getting matched is not going to increase linearly with how much I stake. There's some diminishing return to scale. How is that justified? Well, if we write down a micro-founded model of search, that's something we can microfound and derive. Yeah.
Sorry. Okay. So how is the amount of tokens I'm holding related to how well I can match someone on the platform?
Right. So in that specific example of staking, the rule specified by Filecoin is, well, if you stake more tokens, you have a higher chance of being matched.
Correct.
It doesn't have to be the only application. You can view this as, for example, if I'm doing smart contracting with a transaction counterparty, of course, if I enter a smart contract, my tokens have to be locked with that contract, otherwise it cannot be self-executed. In that regard, I'm also holding token. Right? It's just a way to capture this fact. Convenience, yield, if you work on commodity. Basically, by having US dollar, it makes I derive certain utility conducting business in the US. By having euros, I can derive certain utility being in Paris, for example.
Right.
Yeah.
I see.
Yeah. Very reduced form, but we're trying to provide a micro foundation.
So I have another very similar detailed question, or basic question rather. So you have the platform productivity equation here.
Yes.
So, I understand geometric Brownian motion is going to be convenient, fine. But what if mu is 0? Do you still have a theory? Or is it a key ingredient in your explanation of the price of a token?
For it to have positive drift, is that crucial?
You need it.
Yeah. So in the paper, we focus on that case, but the economic intuition can be similarly described when mu-t is negative, when it's drifting down. So in that sense, it's symmetric.
I mean just 0. So this is the service.
This
is it. Maybe it grows with NT, but
I conjecture at 0 the effect will be gone, but I can't be 100% sure. I need to double check. It could be there's a either positive or negative threshold where the effects switch. I just have to double check. That has something to do with the second order volatility term, but yeah, I have to check on that.
Thank you.
All right. Thank you very much.
Thank you.